broadcast is now starting. All attendees are in listen-only mode.
Hey guys, can someone type in questions whether you can hear me okay? Great, thank you. I'm trying to share. Can you guys see my screen okay? Cool. See, I'll start when it gets up to, we got 9 now, so I'll let it hit, see if it hits 20 at least, and I'll give it a go. Nineteen and counting. All right, that hit 20. All right, guys. Thank you for joining. Again, what we want to go through today is how to trade Elliott Wave. And particularly, I wanted to do this for those that have joined the site only in my room and have not experienced Elliott Wave in the other rooms. I think a lot of the folks that have joined the other rooms get a lot of advantage with multiple analysts, a lot of members that are experts. I think it's a little bit different in our room with really probably 5 or 6 or maybe a dozen experts in Elliott Wave. So let's get started. Yeah, and this is going to be, if you're an experienced member, I think this is going to be quite a redo for you. I mean, you might be interested in my own style and take on trading, but other than that, you should know most of this. Let's get to presentation. And then I apologize too. I'm really sleepy this morning. I slept okay, but I'm sure I'm going to be a little bit laggy. Okay, so let's see. All right, I'm gonna skip introduction. Just quick disclaimers. I always need to share those. Again, just because I'm talking about cryptocurrency doesn't mean it's a recommendation for you. Does not mean that you should trade this market. It's a very unregulated or less regulated market and very unique risks. So always want to share that. You guys probably been disclaimered to death. What I want to go through is the elements of successful trading. I think particularly since I've grabbed a lot of new traders that have just started to become familiar with trading because of cryptos and what they're doing. I want to really start to give an intro level discussion on trade psychology and what makes success. I really advise if you're new to this that you read, not just what I'm going to share here, because it just isn't enough. You will blow up over time if you don't start good habits. So we'll talk a little bit about those. Basics of Elliott Wave, what really it is, just at an overview, I really advise, again, reading on it, particularly Prechter's book, The Elliott Wave Principle. Links to that are in the site, in the education section, and a lot of videos in the education system. But I'll talk about it a little bit. And then, how we use the analysis on the site, and I'm going to talk a little bit about my own personal style to analysis. So hopefully it'll allow you to read charts a lot better. I get a lot of questions. It was obvious that they had not experienced Elliott Wave analysis. So I'm really going to get practical about it. Where do you enter? Where do you take profit? Where do you stop, et cetera, at least the way I approach it. And then understanding this idea of skew and probability, again, to be successful, we'll talk about it, but you really need to start to not embrace accuracy so much as probability and how to manage it. And so we'll talk about those terms, and then using time frames. That's just basically playing kind of a long-term trend versus a short-term trend. Hopefully it'll make sense. And then we'll do a little bit of Q&A. I really want to avoid chart analysis if I can. If there's really no questions about the topic here, then I don't mind talking about a chart, but I want to keep the webinar to 90 minutes if possible. And then we'll see how that goes. Let me just check, make sure we're recording okay. Hopefully all that. So, being successful, it's really, really common. I get the feel on the site that new traders want to expect me to be accurate all the time. and get a hit rate that's really high. I think my personal hit rate usually hovers around 65, 70%. When we tracked it on the site, that doesn't mean that a trade fires off immediately and is timed well, but it does mean that over time, usually I'm profitable about 7 out of 10 times. Just tracking my own statistics. However, that's really not the best measure of success. So here I say mature traders embrace probability and understand the elements of being successful. And these are really the things you need to add to your menu, in my opinion. A directional edge, of course, and that's what I'm talking about. Use it when you have it, but you also learn to back away when you don't, or you minimize your position. So you may, if you don't feel like you have a strong edge, you really should learn to drop some of your position back, so you're not playing hard against something that you don't have an edge on. And when I talk about I don't have an edge on a chart, you better believe I'm not really trading it hard, at least not beyond the core position I already have in most of these coins. And then position size is, I've talked about it a little bit already, but it's sizing according to probability, it's sizing according to risk management, and it's also this idea of positioning heavier close to the stops, so that when you stop out as part of your pre-plan, that you are not taking the heaviest loss you possibly could. And so we'll talk about that. And the risk management, I mean, all these are really tied together, but it's minimizing losses, maximizing gains. And I really want to emphasize also maximizing gains, because it's those times when you take the most profit possible out of a trade that you really cushion your portfolio and cushion your own situation psychologically, so that you can be successful. And then don't blow up your account. I mean, we really talked some basics in here about avoiding blowing up accounts, but man, I blew up at least 2 or 3 accounts in my life, not in cryptos, but in futures mainly, and in options, when I was learning how to trade back in the day. And so, it's kind of the normal course. What I advise also, I should say, is that, when you're learning how to trade, start smaller. You may have $100,000 in the bank. Please don't put that in trading until you've really learned to do it repeatably. And then probably what I should have said on risk management is just all trades should have some sort of plan. And I think that what Elliott Wave theory and principle and the way we do analysis on the site really gives us a lot of pre-planning. I talk about stalking some trades for months, and it's really Elliott Wave that allows me to do that. And the more you start to understand that, you can start to pre-plan your trading life instead of being always on the reaction side of the market. I mean, we are reacting to the market when we come into correction. We do want to try to grab that, but that's a little different from really not understanding where the market could go prior. And so when corrections happen, I'm really not surprised. And usually when rallies happen, I'm not surprised. And I'm using Elliott Wave to kind of figure that out. How does Elliott Wave help? And I want to kind of give a little bit different take. I think that we often use the word prediction on the site, and I think we abuse the term. So I actually want to really talk about Elliott Wave not as a predictive tool. It certainly seems to at times, and I was drawn to the site personally because it seemed like Avi could predict the S&P 500 in his writings. But it really isn't so much as a way to structure the market into a few choices. So, I have usually a white count and a red count, and I've been criticized by new folks to the site. I've received that feedback, but it's really the fact that I can narrow the market to a couple choices that makes it manageable. And so you have to start to think about it differently. And so you have to understand, you have to form your plan around the way the market goes. If you believe my analysis and you believe those potentials, then you might want to make a plan for whether the market takes one route or another. I mean, it's awesome when I have 2 alts and they're both bullish. I love it. It happens sometimes. I just can't see a bearish alternative. But sometimes, like Bitcoin right now, I can see 2 or 3 in each direction, which is, I don't trade a chart like that heavy. And so we'll talk about that. A mature trader can use those structures to work probability in their favor. I mean, that's really what I'm trying to talk about in all of this, is how do you take probability, loosely stated, and make it profitable for you in the long run. Further, Elliott Wave has a way of giving price context and quantitative sentiment. That's not really a great sentence, but it has a way of managing and understanding sentiment in the broader market. It also gives context to trading systems such as technical indicators and patterns. So it kind of, I'll use an example. Most trading indicators, particularly MACD and an RSI and moving averages, have a certain character in certain market phases. it's really Elliott Wave for me that gives context to that and helps me interpret those better. 'Cause if you're using indicators regularly and long enough, you know that they shift, and you either learn how to manage that if you're just a technical trader, and do it successfully, or you struggle with it. For me, Elliott Wave's taught me how to put those in context. And in the wrong way, I have an article on this that I hope everyone has a chance to read. It's in the crypto education system, but or education link. It's how to manage a moon count and how to plan right. I mean, crypto's put out moon counts simply by the mathematical structure using Elliott Wave. A lot of those moon counts, for example, Bitcoin and Ether, have really played out. But if you put all in hoping for that to get you rich someday, you're really making a mistake. That's really a abuse of Elliott Wave. Although I think we will see some go there. It's just if you're not managing it along the way, you're really making a mistake. Trust me. Where's my? All right, I'm not usually using this computer. Okay. Jeez. All right. So the basics of Elliott Wave. So R.N. Elliott, I think it was 1938, so I got off Wikipedia, discerned that the market follows a repeated pattern or fractal. It's these 5-wave structures. Again, a lot of you have heard this before, but I want to make sure those that are new know all this. You can go to the Wikipedia page to get a quick review. Again, just an overview. You can go to webinars on our site. I really recommend over all of that, starting with Proctor's book. So in that 5-wave structure, 1, 3, and 5 are motive or impulsive. So that means they move the market forward. Waves 2 and 4 correct. So they kind of pull the market back. So it's kind of a 3 steps forward, 2 steps back. So there's always progress in the market. These patterns are fractal in nature. So subwaves replicate the larger pattern in log scale. So what I mean is if you dive into the 1, 3, and 5, they also have 5 waves. They're moving forward and 2 steps back, while the greater pattern that they are part of is moving forward. And we'll kind of look at that a little bit. And then waves 2 and 4 actually have a 3-wave structure, and we label those ABC. You'll see other patterns like WXY, 5-wave triangles, 9-wave triangles, which are a little bit different from this ABC, but most will fall into the ABC. We just had a bunch of what I call WXY bottoms, and that's a labeling that sort of pertains to the subwave structure a little bit differently, but they all kind of fit into this corrected pattern. This is kind of a drawing, sort of basic proportions. I mean, some of the characteristics you can see, look at 1 and how it's subdivided into 5 waves, the 2 into ABC, the 3 into 5 waves, and then the 5 into 5 waves. I just kind of drew this by hand. I try to draw out proportions. What's really important is that the 3rd wave subdivides and extends. So even that little numeral 3 within the 3 is also subdivided. I just drew it straight, but it would have a lot of subdivisions. And really what we're always trying to trade for or put our heaviest position is really that 3rd wave. So I don't know if I made that clear enough in this presentation, so I want to emphasize that. You really are going to have the best advantage if you focus trying to find the 3rd waves. Even if you just catch a few sometimes, especially in cryptos, you can really just pay off. You can really almost sometimes get your 1-year return goals just on a couple of 3rd waves in cryptos, which is kind of insane. Excuse me. I put this little note, and this is me being firm and feedback with just with all love for the subscribers. I really hope that you guys can start to understand this visual, because I've gotten a lot of requests for charts that, hey, is this impulsive? And there's nothing impulsive about it, and it really is a lot of time for me to find it. So just look at this visual, look at this substructure. Note the 3rd wave is extending, and the 4 and 5. Sometimes it's worth looking at a chart if it's got that extended 3rd wave character and we just haven't seen the 4 and 5. But if you're seeing something going sideways, chopping up and down, and put your charts in log scale to make sure you see it, it really isn't that helpful for me to sort of find that chart and look at it and then just come back and say, sorry, that's a terrible chart. So I just really, no offense, I know a lot of people have done that and a lot of people are not versed in it. I really mean it in utmost love, but it's also just for benefiting all of our subscribers. Just so I'm not using time just looking at bad charts. I'm looking at about 90 now, roughly. I think it's close to 100, and it's getting time consuming. So, and even though I have a watch list, I'm still looking at the other charts. I'm still myself kind of scanning them every once in a while to make sure something else doesn't show and make sure my counts are going. So it's an awful lot of charts. But it's, it's for the best of all of us, my return and your return. I just realized that C is below 4, bad way of labeling. Anyway, I just caught myself. Anyway, so let's move on. Elliot and Sentiment. So Elliot is really pertains to what is happening in the psychology of the market, the sentiment of the market. So wave one is typically the end of, it's the end of a bear market. It's the first pop. It's the wall of worry. I'm sure these words are a little different from Elliot or other people that have written on it, but these are the way I sort of see it. Wave two is believed by the masses to be the return of the bear market, and large degree wave two is often bring bankruptcy because people get trapped in that first wave up. They're the deepest correction in proportion to the previous rally, wave twos. So they really can throw people for a loop. The wave three is where, if you think about the wave two shaking people out and bankrupting some, it's the wave three that is our strongest trade because no one's in it. And there's this constant march of no positioners, as I call them, or people that don't have any position and are bringing that new money into market. If you think about markets needing new money to move forward, because there always has to be a new bid. So you need to have a place in the market where people are getting roped in, and it's really the third wave. And then eventually that comes to a point of extreme sentiment, and there's no buyers left, and so you get a wave four reset of sentiment, and then finally the blow off. Often wave fours are very choppy and shake people out. You guys all remember July if you were trading into, what was it, October, November, before it really finished, the large wave fours on some charts, and there's so much frustration on the site. That's their nature. Wave five is the final blow off. They're often weaker than three. They're definitely weaker in price movement. Sometimes they can be very dramatic in velocity, and that's really the blow off. Sometimes they can be extended, particularly in precious metals. But it's a trap coming because those are the folks thinking this trend can keep going. And then you start a wave two, and then people bankrupt or blow up their accounts or whatever. So, it's really nice to know all this, right? I mean, you can basically, work against the crowd, so to speak, or at least not become part of the crowd and participate in sentiment, be victimized by it. We have a mathematical structure in Elliott Wave that actually all of the wave patterns I have been mathematically checked and cross-checked and all of that based on these formulas. So I don't want to go too much into this formula at a detail level, but it's here for you, and this will be up on the site. You can kind of take this down. But before we had the code, before I had Motive Wave working for cryptos, and before I had TradingView, code that we made for log fibs, I had been running a spreadsheet to place all of my targets. I couldn't even run the analysis continuing to do that. I could not run the site doing all these charts at all. But the fact that we made the code in TradingView, I can work a little bit faster. It's still painfully slow. Where if you're working in Motive Wave, you just lay it out visually really quickly, and then boom, you've got log fibs. So anyways, it's complex calculation. I won't go too into it, but we've got typical extensions. So once you enter the zero, the wave one, and the wave two, you get this relationship. You get this relationship of all these extensions, and these are our targets. Just as I say below, variations show up. We get extensions, we get shallow waves, so we have to also play visually a little bit. I look at a chart, I look at it visually first, and then I start finding all the mathematical relationships, and then I lock down my count. I don't judge counts visually. I know Prechter is strong about that, but I think visual is just the first take, and then mathematically I lock down the count once I find all the relationships, and then I also find places where my count fails based on the math. So it's quite a process. I mean, it's actually really involved, and I don't think everyone understands all of those aspects of doing analysis properly. And so when I'm coming at a chart really fresh, you guys ask for a chart and I come in very quickly, I have very low confidence in that analysis, and that's just a challenge. And it's not until I watch a chart and have all the levels where I find invalidation of my analysis that I actually know whether I'm kind of onto something or not. So it's just a challenge, but it's pretty amazing once you have it down because you have this huge advantage. So just basics of entry and stops. So these are they're basically in Elliott Wave. To me, there are two entry points, the wave 2 and the wave 4. You can enter on breakouts of wave 3, breakouts of wave 5, but we'll talk about that a little bit. You start to wreck your skew. We enter on the 382 to 618 retrace of wave 1, and that's the wave 2. We like a nice deep 618 retrace of wave 1 for wave 2. Also, 764 is fine. We get a lot of those in cryptos. We get very deep twos sometimes. They just start to challenge whether they're going to drop through the bottom. So the stop, the obvious invalidation is the stop below the 0 point. That's the beginning of the wave 1. And I'll try to point. I'll go back and point these out on the wave drawing. You can also put a stop at the 764. And that's where I like to do it. If I get a drop below 764, I'm very skeptical we're still in an impulse at all. I mean, it may be that we turn up below the 764, but might have a diagonal B wave or something else usually. And then entering on the wave 4, it's the 1.0 projection using the calculations that I showed. It can also be calculated the 382 retrace of wave 3. Especially if your wave 3 is extended, you kind of want to use that calculation. And then the stop. Oh, that's a wrong right there. Stop is actually, yeah, sorry, no, this is correct. 764 or 0.5 retrace of wave 3. So 0.764 is the 3-point projection in the calculations prior. And I'll kind of show these in trading view, and then 0.5 retrace of wave 3 if you're using a retrace tool. I know this doesn't mean a whole lot to people that are new to all this, but it'll start to come together. But really, when I'm doing analysis, I'm showing you all these prices in the chart. So I'll explain that. So you don't have to memorize these numbers, so to speak, but you want to understand what it means on the chart. And it should be plain by the end of this. So you enter your largest position most of the time close to the stop. So that gives you best skew, which is risk to reward. We'll talk more about that. And you're waiting for the reversal and pullback to get a bit more confirmation that'll hold. So you're watching for it to stop out as soon as you enter. We've got a question here. Let me see if it's worth taking it now. No. Yeah, we'll get a copy. Okay, I'm gonna. That's drive me crazy. All right. Okay, so I want to talk about skew. I think that skew is EWT slang. I don't know if traders use it outside of our site. I think HD in the main room is the analyst that invented the word. I could be wrong, but he uses it all the time, and I certainly picked it up from him. But it's really a slang. It's really slang for risk to reward. So if you got it, I'd really suggest internalizing this really well to help with your trade plans. So risk is that dollar at risk if stop is hit. So if you say you put $5 and your stop is at $4 when it hits $4, so 20% loss, that's your risk, right, in percentile terms. And then you should have a target on every trade. If a lot of new traders are trading without any plan at all, and that is not true of me, and I hope it's true of very few of you. If not, start to figure that out. All of your trades should have a risk amount at risk and a reward target, and Elliott Wave gives that for us. So typically in crypto trades, we have this skew of 10 to 1. And that means that often I'm entering with a 30 to 50% risk on the trade, but I have this crazy reward usually, 1, 3, 5. 1, 3, and 5 multiples. Sometimes we see 10, and I think we had a 25x multiple trade from early on in the service, and it's sitting on I think it was XLM. So we get those. And again, so you have to just internalize each of these trades according to your count and your position sizing. So we'll talk a bit more of that. And if you're not doing this, you're headed for trouble. I guarantee it. I'm going to keep it here for a second. I know I just jumbled through that. But when I say skew, this is really what I mean. It's really thinking about what we're risking for what sort of return potential. Talk about probability. I think it's funny to use the word probability because it usually pertains to statistics or numbers. So people ask me, what's your probability on this trade? I try not to spout statistics. I do for fun. If someone asks me, what's your probability on this? I say 50-50 or 60-40. If I say 100%, I'm all in. I'm really kind of sort of joking, or I'm being very intuitive. Really what I'm saying is, where the trade is in terms of this sort of scale of probability. So generally a reversal or catching the hot knife, as I like to call it, is the lowest probability trade. You're basically catching a reversal while price is moving in velocity, but your skew is the highest. And what I mean by that is the stop is pretty close and your reward is farthest away because you're catching the reversal. Um, Buying a reversal in progress with technical divergence, which we'll talk about, raises that probability a little bit. That usually means that price is starting to lose momentum to the downside, and so you have a stronger reversal potential. And buying the first corrective pullback after a strong reversal raises it further, and then buying the breakout is high probability, but by now your skew is greatly reduced. So often it's breakout that really confirms our counts, but the problem with buying breakouts is that you're well above your stop, and it's going to be the most painful trade if you happen to go back down to the stop. So hopefully that makes sense. So that means that there's kind of an inverse relationship to skew and probability. It means that as probability increases, your skew starts to decrease. And so I personally like to balance it. So we've got some questions. So let's see. Man, this is driving me crazy. Likelihood. Okay. Yeah, that makes sense. Thank you. um, this is doing this. All right. So basics of risk management. I mean, there's a lot to this. This is my take, but every single trade you have should only risk 1 to 3% of capital. I mean, 1% is the careful version. I tend to personally move to 3%. You could say capital or total bankroll. Bankroll is kind of the gambler's term. And this is entry to stop in my point of view. So example, if you enter, I think I got this math right, but you enter a $10 trade with a $7 stop with an account size of 600, 1% rule means about you're positioning 2 shares, so to speak. So you've got $3 at risk per, times 2 is 6. So that's risking 1%. So hopefully that makes sense. Then a simple reason for this, every trader has a bad run. I mean, you will have bad runs. And if you are stopping out repeatedly in a bad run and doing so in heavy positions, which I guarantee will happen in every trader's life, those that wish to trade successfully, you will go broke. It happens. It's just very simple. The paradox of trader psychology. So in general, mature traders follow this more religiously than those, even though they have a higher hit ratio. So because they've weathered bad runs themselves. I mean, I have blown up probably 3 accounts in my life, all futures and options, something like that. And I just don't blow up accounts anymore because each of my trades are relatively small to my bankroll. There is another formula out there that I do suggest reading, and that's or reading about. It's the Kelly Criterion. There's a novel that kind of gives its context called, or it's kind of a documentary called Fortune's Formula. It's a great book. It doesn't actually explain the Kelly Criterion, but you can read about its creation, and it's actually for gambling. How to set your bets in a gambling situation with your account by tracking your own statistics. But there's been some adaptations for investments. And then and literal, and I mean this kind of joking, but I have a point. Over positioning really leads to mental illness. It at least leads to poor decision making because you're so tied to a trade. If you have so much into a trade, you really don't want to stop out. You end up not stopping out when you should, and you and then you do this repeatedly, you go broke. I can tell when some of you are over positioned just by listening to you. I get PMs from some folks wanting to know charts when they haven't moved. A constant request for a chart that isn't moving or going down, but I have repeatedly said I don't have an edge on it or I don't know what it's doing, just kind of says to me you might have too much at risk. Just think about it. I can't, it really hurts the whole group if someone's asking for the same chart over and over when it hasn't moved, because it distracts me from the rest of the work I have to do. And I suggest to you that it's a potential that you have too much into it, both emotionally and financially. And I mean that I mean that firmly, but at the same time, because I care. So skew wisdom. I don't think it's a bad term, but I think it's a bad term. But so skew alone can actually make you profitable. So again, early traders really want to have an edge on direction. They want their analysts to be right. But it's actually skew and repeatedly being in trades that have great skew that will make you profitable. And I like to quote, I think it was third quarter 2016 or 15, I can't remember, a couple of years ago. I had a 30% hit ratio trading options. This is before I really went heavy into cryptos. and I was mostly trading options. I had a 30% hit rate, but I was profitable. And that's because I was in high skew trades, and a lot of them, all those option trades go to zero. It's really because I was capturing as much of the range as possible. So maximizing skew is not getting the direction right at all. It is entering as close to stop as possible. So if you lose, it's tight and it's capturing most of the range as possible. If you're repeatedly capturing a large part of the range and not being nervous nilly and getting out early when it's possible that it can keep running, then you will basically shelter your portfolio over time from loss. You'll be less emotional about the trade, and you'll be very willing to kick a trade out when you hit a stop. So if you do those two things, enter as close as possible and capture as much as possible, you will over time be profitable and be a much more confident trader and really be in control. So it's just something you all have to shoot for. Let's talk real quick about using my charts. The boxes I put in my charts matter a lot. They're based on the fibs that we use in Fibonacci Pinball and Elliott Wave. And they guide you, if you understand them, they guide you on where to enter, and you don't have to ask me. You will see it and you will be able to start to trade. So if you look at, this is SAN, so SAN USD. I snapped this morning, and I have the two boxes, and these boxes are based on, this has an extended third. So the first box is the top of the box is the 382 of the length of 3, and the bottom of the box is 0.5. And then the top, I use the extension tool. Someone asked during the week how I manage targeting in an extended third. So I measure the third with the extension tool, and it's the retrace tool for our trading view code, excuse me. And again, so 382, it says 618, but it's basically 382 for the top of the third, 0.5 for the stop, and then the 1, 2, 3, and 1, 3, 8, 2 is the target box above. So basically, when the market's coming down, the ideal entry in Elliott Wave is the top of the box. You wouldn't do it here because price was moving with velocity. You can see it spiked right through. So we'll talk a bit about technical divergence, so we can not catch the knife. And then we have a stop below, and you see this one went straight through, but you can see right there that the Elliott Wave stopped the precipitous market decline and then turned it. I mean, it's not driven by Fibonacci's, it's sentiment, but you can see that it works. It spiked a little bit below the box, but that's okay. It happens all the time. But if it retraces and goes straight through, then we know we have a stop. So that's how I've talked about this is how I manage stops using Elliott Wave. I don't freak out with just the first spike. If it spikes through to the next fib line, then I'm out. And then so that's the stop, and then above we've got profit taking zone. So we have the box where we start to take it. There's also the thirds. I don't have the third on this because I'm not sure we have a solid 1-2 or a B wave, but coming. But we would take profit on the third wave up, or I would, usually 30%. And then by the time I'm in that box above, I'm down to my long-term core position, which we'll talk about. And now if I push to the top of the box in the situation, I start to think I've got an invalidated count to the bullish side. So I've got to start looking at some other structures. Certainly, that doesn't mean, so sometimes when a market breaks through the top of the box, you don't necessarily want to take any more off. You may want to ride it further, but I have to do some more analysis. Let me check out questions real quick. Do you use mental stops or stop orders? I actually use mental stops. I don't advise that with everyone. If you're a new trader, you may want to put stops on the market. The problem is what we have with all these BTC pricing, and I'm not using BTC pricing because a lot of the charts are diagonals and really tricky charts that I can't target well, while the USD charts are all very clean. So it causes us an issue. That's where I use TradingView for alerts. I use let's see, I've been playing with apps, but a lot of the alerts don't go off. There's a new one, Delta, where you can set alerts, and I just haven't tried it yet. I'm going to give it a try, but I love the Delta app otherwise. So you can set stops, mental stops using alerts in with apps, but you have to be very disciplined and take them. The problem with mental stops is that people don't take them when they should. So anyway, hope that helps. So having a problem times getting rid of this. Let's see. Without getting, let's try that. Jeez, interface is funky. All right, so I'm going to talk about two styles of trading this. I'm sure there are lots of people that have other styles, so I'm calling this one the scaling. And so here's a box in TradingView. I use these red boxes, and I'll draw a line, and over to the right you'll see the price. So this is a wave 2. So the top of this box would be the 382 retrace, the bottom would be the 618. When I'm on top of everything, I also draw a line at the 764. That's your stop or a low entry. It's just when you hit the 764 and go through, you may have something else besides an impulse coming. But this is the box for the 382 to 618. So again, you can check out how the market's just bouncing inside this box and keeping that stop. The scaling approach, you have to imagine this triangle as basically your position size. So when you're, again, you want to have the largest position next to a stop. I mean, and you're talking, $40 on top and 34 under. So you're basically almost 20% difference in value between these two lines. So you really want to have as much as possible. And then if you start to get a spike below, really the stop is a 764, so it's below here. But if you start to get a spike below here, you may want to cut your position or consider it at least. So again, if you're positioning it in this triangle, and this is again your largest position down here, you imagine that's money, then really you have very little pain because a strong spike below that is a legitimate stop out at least, or you can say, you can ask me where's the 764 on that trade, and then that would be a real warning. So that's one style. Again, just hope that makes sense. I'll take questions after I get the two styles in. And the other one is more of and I learned this one from HD or listening to him and kind of have developed this. And this is the style that I tend to use. So I call it sort of enter and pressing. So pressing means that you're adding to the trade as it becomes successful. So here's Ethereum snap this morning, and we have to me this is already a confirmed WXY. I know a lot of people don't like WXIs, but we're seeing a ton. And we have a very clear 3 and 3. So 3, 3, and 3. And so, often when I sort of see the first 3-wave move and I see a bid, I would take a C position. I wouldn't in this one because there's no technical divergence. So we'll talk about that again, but I wouldn't have taken a position here. We do have a turn up, but we don't have it may be on a smaller time frame that we see some divergence, but it's really not clean technicals here. So I probably wouldn't in this situation, but usually in the 382, I'll take a small seed position. And then we get the harder down into the 618, and this one hit the 382 and the 618 on the nose, as I recall. And so I'll take a stronger position. Now, as the trade develops, and unfortunately this isn't clearly impulsive, it may be the start of a diagonal or something else, but as the trade develops and holds higher support, I will start to add. And you can top off a trade at the breakout. It's just I naturally I should have drawn a line, but if I think about this, these are so small positions, and then I go bigger as probability increases. So once you start to see higher lows out of the 618 retrace, you have a possible successful trade already in progress. So I'll be a little bit larger in these trades. And you can add you can sort of top out and chase a breakout, but you want to do that small because your skew is sort of going away. You're well over your stop now, and if you put a big position in a breakout, you can get hosed basically. Okay, let's take a question. The QTIM chart was the first one. You think it's a 3-wave move? I don't think so. I'll break it down later and maybe answer the question on the site, or rather in EW. I think it's a 5-wave move, but it's a funky looking one. But anyway, we can talk about that on the site. See if this works. I don't have to go back and forth. No. That is a weird interface. It looks like my image is slid over. That's okay. All right. So here, divergence. I think a lot of people have asked. I think this is a real important basic level technical analysis. I'll really admit, after really relying on Elliott Wave, I've lost a lot of my technical ability. I don't think I'm great at technicals like a lot of folks, but I've been getting better and focusing on a little bit more. In fact, again, when I'm using the levels from Elliott Wave, I've said this on this chart on the site quite a bit. When I'm trading a clear impulse, I literally turn off all the indicators because I don't need them. I'm just trading levels. But indicators are really helpful for me, and hopefully you can learn how to use them to really spot bottoms. And I'm starting to get better at it as I grow. So divergence is basically, again, I want to emphasize that indicators are really just qualitative aspects of price. I don't believe indicators actually throw off signals that some people will debate with me, but they do show a nice qualitative aspect of price. And so MACD is a momentum indicator, and what you see here, as this is Verge snapped this morning, you see Verge coming down. You see this low point, and you see a lower point, but we see basically MACD going the other way. And so that's technical divergence. You often see it also in RSI, but we have a different element here, or different aspect or happening here, where RSI really spiked down and broke down, but price didn't go very far. It got a little flush, and then it reversed and then broke a trend. So a little bit different in each one, showing something different. But basically, we have an inconsistency between the indicators and price, and then we have price starting to turn. And I think before I turn this on, I saw a real strong move in this price. So it may be that we're underway. I'll have to check it out. I'll check it on the site once done. Another thing, and these two slides, I mean, technical divergence and this slide. And this slide, I tend to be really good at this because I watch the market so closely. These are just ways to sort of pick off bottoms. And again, if you go back to, let me reverse back. If you go back to this is really how you're judging these first seed positions and feeding. Now, these are the lower probability trades for these two. It's that initial bottom. So the position sizing is naturally smaller. So if I think about a curve reflecting position size, it should be heavier, at least in my opinion, for me, in my style. It gets a little heavier once the trade starts to strengthen. So in this area, but in these first sort of onset of a possible bottom, I'll go in with seed positions or small positions to try to pick them off. So I'll do my first one often in the technical divergence. But another thing I look for is this, I call it the capitulation and bid. So we had Bitcoin recently come down, in an ABC, super clear, all the math is right. And so I'm just so used to Bitcoin. I trade it so regularly. It also has a tendency for WXY bottoms. I went over all the WXI bottoms since 2015 a couple days ago, and I found, I think it was 15 or 16 WXY bottoms where we had 3x3 bottoms and no fifth wave on the bottom. It just has that tendency, and I know that. So I basically picked off this bottom when I saw volume shoot up, and then I saw the big green bar on high volume. You can see the large volume right next to it. And it's not that it just happens. So I'm not looking for that anywhere else. I'm looking for it right where the C equals A. So it's basically the 1.0 to 1.382 fib targets. If you're using a projection tool, I do that all the time. So I actually bought Bitcoin at this very bottom. I didn't do a large position. I just basically added to my core with a small position, and I figure if this whole thing breaks down and we end up at 4,000, which is the sort of ultimate bull market target or bull market support for me, maybe as low as 3,500, then I'll just add more. But I was able to pick off that bottom in case this confirms as WXI and takes off. I still have no edge on this chart. Let's see if it's progressing today. I'm still not sure this one's not going to break down, but I at least wanted to add a little bit there. So anyway, this is just a technique. If you watch the market really closely, you can see the capitulation happen and the bids start to come in right at the fib target. And if you're not clear where that's going to be, just let me know. And then if you have a cumulative delta tool, which I'm working with somebody to try to build one, you'll start to see the order book flip when this happens. So you'll start to see basically the sell side of the order book gets swallowed by the bid side. The problem with crypto is you have all these exchanges, and some of them will show it, some of them won't. So are you on the right one? That's the question. But in equities, you would use a cumulative delta tool to see that. Joffe is great at that, and he's talked about using that tool in those situations. Again, warning on indicators. I mean, indicators to me are qualitative read on price. I mean, if it's a momentum indicator, they're basically showing momentum. There's a lot of other indicators that are trying to show different things, trend indicators, et cetera, et cetera. So that's really what they are. They're not price indicators don't drive price. Price drives indicators. And indicators are most of them are look back. I mean, I don't know how mathematically you get a look forward. I'm not a math expert, but most of them are just designed that way. So lagging. So all you're seeing is history, and the question is whether history leads to future. Um, and then divergence. Divergence is not a guaranteed signal. It can break down. Like divergence will show up. It's a key. It's a indicator of a possible bottom, but price can destroy it if it decides to turn. Signals on most indicators are a tenuous concept, in my opinion. I don't talk about signals with indicators. An MACD crossing is not a signal to me. It's simply a waning or increasing momentum or change momentum, nothing else. But they can clue you into the qualitative situation. They can give you a hint of where price may turn simply because the situation may be changing, whether that be momentum. Nice misspelling here, Elliott Wave. We expect indicators to work a different way in each structure in the wave count. So for instance, use example, we often see MACD throw off sell signals in the middle of a third, but doing so very high up in the oscillator. So so a lot of people will freak out about an MACD sell while it's in the middle of a third, and I'll just ignore it. But that's just simply because near the top of the third, you start to have waning momentum, but that doesn't mean the price is going to roll over. So you have to just put it in context to where you're at in the market. I mean, people that just use indicators know this, and they sort of compensate for that. I had a typical trade where in equity options where I would, when I saw a price go very flat, I would go long the first RSI oversold because that meant you had a very quick switch in momentum long. So that's using it in context. So price was in compression and going sideways, and then I would literally go long the first quote unquote oversold signal in RSI. It works really well. I still do that every once in a while when I'm trading equities. So lastly, see, is that all I was about to cover? Wow, I flew through this. Okay, so lastly, I want to talk about time frames. I use all of these terms on the site, core position, short-term trade, et cetera, et cetera. What I'm kind of giving you is a picture of the way I trade two time frames, which would be the swing trade plus the long term. I'm thinking about fusing the portfolios because I think it's getting a little heavy and confusing to people. But right now, the way the portfolios are designed, long term and swing trade, they're sort of my trading. It's really like an extension of my trade plan. When you think about Elliott Wave fractal, so again, you have this larger wave 1 and 2, which we're not even showing the rest of, but inside you've got a subdivision. I'm basically putting in core positions for these long trades and cutting them when we get to tops. So my core will, I have basically a long-term hold that's sort of fluctuating along with the market, getting cut down and taking profit in these bigger count areas, 3 and the 5 and the 1, and then adding big time at the 2. Then meanwhile, I'm taking all these little trades and taking some of that profit and shoveling it over into my long-term core. So for instance, if you're new to this, you would try to find a place. If you've never had a position in crypto, you would enter a core position, in one of these trades, and it might be like a short-term trade, but you might choose to hold some of that as a core for long-term, and meanwhile just take some of the profit in key spots, say 30%, 50%, whatever, and then take that off into fiat or into Bitcoin if you want something less volatile, and then add back for another short-term trade at some of the next retraces. And then eventually you start to grow profit short-term and you start to shovel it over into your core position. That's the way I trade. So what I hold now long-term is quite large compared to 2 years ago where I had very little profit in cryptos. And then there's a lot of things where I'm aggressively trading in and out. You guys have seen that I often take 30% off at the thirds, and often that's all of my principal. I do that. And then I also use thirds to rotate back down into, ones and so the lower counts, the lower twos for things that just haven't taken off yet. So I buy those laggards with some of my profit from something that has taken off and done very well. So I take those strategies and I call those out. So if you think about your sort of future in the next few years, what you're going to hold in your portfolio versus what you're going to trade short term, have a plan, internalize, write down whatever it takes, what you're willing to hold through the heat, and then and then sort of try some short-term trading and take things on and off. I think there's a mistake where you think of all of your trading personally. I think very few are skilled enough, and I am not either, to basically take a whole position on and off during short-term trades. I don't think I ever know any great traders that are able to do this. So consider what you're good at, and then set your plan accordingly. And sometimes it takes a long time to learn what you're good at. Are you good at short-term trading? Are you good at just holding through a lot of pain? And then, one thing that's important, and unfortunately I had to change computers. Hopefully I can show you this. On time frames, the larger fib fractals, because they're calculated over longer time frames, the fibs are just farther apart. So if you think back to the boxes, say a box on a large, weekly count, the stop is much farther from the ideal entry. So when we were entering long-term positions in the wave 4, they had a lot of heat built in. And I don't think a lot of people internalize that because the board was very frustrated. I knew that, so I was pretty relaxed. But if you're using a larger fib fractal, you're just going to have a lot more heat in the trade. So sometimes you want to make your core smaller, just for comfort level. And then the short-term trading has a tighter fib structure based on local fibs, and so those fibs are closer together and the stops closer together. So just internalize that as you do this. And I want to try to show that. Let me see if I can get a good read for you guys. Unfortunately, well, let's see if I can do it in Motive Wave. Hang on. I haven't opened Motive Wave on this computer in a while, so I don't know if it's even going to work. I gotta open on the other machine. Hang on. Sorry, I had to change machines real quick. Shoot. All right, let me try it with TradingView. So I'm going to open up. So here's Ethereum. Going to the day chart. I'm sure like my count's wrong now because I've adjusted this count since. Yeah, so all right, so these fibs should be based on, let me verify. Yeah, so these fibs are based on the 1, 2. Let me draw that out. I'm so sleepy. All right, so that's way off in time scale, but that's basically what we're looking at. I'll explain this in a second. All right, so so I have the fibs for the 1, 2, so the 0, 1, 0 point, wave 1, wave 2 in Ethereum, and it gives us basically around 3,500 is the wave 3 target, and that's the 1.618. You can see it there. And then we have the wave 4, which falls into the 1.0, and then we have the 2.0 for the 5. So we're coming in on the third wave top. And then, so if you internalize stops, so what did I say? When you are entering a wave 4, and this is, let me do one more fib set. This is the way, there's some argument amongst our staff about what's what in this. I'm going to do it this way. This is the way I've classically believed. This is moving, has an extended fifth for the third, or I believe it is now, based on its action. Lots of reasons for that. Okay, so this is the way I have this count. And when we were trading, when we had a top in June, it was at the time I actually thought it was a lower top, but I think now it's the third of the third. And then we have wave 4. We have the key Fibonacci's here, support for that count as it's actually 764 is the fourth. So the ideal entry is 126, turns out, if I use this count. But back then I was measuring the extension of third off the 2, and it's the 382 of that wave. So if you measure from here to here, the 382 down is the entry, the ideal entry, with 50%, as I stated, the stop. And the difference we had was roughly, here it's showing up as 126. It's around there. I think it was 150 if I used that method. And then we had down to, if you're here long enough, you remember me saying 113, 113, 113. And on some exchanges shows up 100. So that would be about, actually tighter than it looks here now. But if you do think about it, we have roughly a 30% between ideal and the stop. And in equities, you would never see that. You would really never see on your long-term chart a 30% drop, between your ideal and stop. I mean, maybe it shows up in some of the most volatile stocks, but few stocks are really going to show that. But cryptos is really normal, and 50% drop is very common, especially in some of these alts. So in the long-term chart, you're going to see a big distance. Now, if we go in on the hourly chart, let's do this guy right here, assuming we have an impulse. I'm really not sure yet. This is somewhat like Bitcoin, but it's maybe getting promising. So if I take, here you're getting a little demo on doing, so I'm going to use a 755. I'm going to use, it may or may not be right, but let's use that 1167. Let's use the 910 again, just for kicks, just for demonstration right now. Let's see, was it this one? Yeah. So let's turn that one on, this one off. So we'll get our fibs here. And so I'm just going to use example. If we come into a short-term trade here, and we hit this third, and you want to enter on the fourth, actually it's pretty good drop still. It's funny. It's still actually showing. So the ideal third and ideal fourth is the 1.0. So 400. So what is that? I can't even think right now. So it's almost 30%. You still have a 30% sort of top to the drop, and then the stop would be, actually, sorry, but the stop would be a much tighter. So hang on. I'm sleepy today. So 1800, and then the bottom 910. So this is how I handle extended thirds for someone who asked. So we put those two levels here. So you get the ideal entry in this, using this method, it's 1396 and a stop of 1296 to 100. So it's less than 10%. So I don't know if you guys catch that. But when fibs are tighter, the point is when it's more short term, you have a tighter range between ideal entry and stop. This is a little bit off for some reason, but my point is when you end up entering in a 1 hour chart, you get a much tighter box on any of my charts. So my point is that when you're using a core trade, you're just going to take a lot more heat. When you're entering on a short term and building on short term, they should be much tighter trades, and you can risk a little bit more if that fits your plan. So hopefully that makes sense. Sorry that took so long. All right, so that's kind of the point of managing the time frames. All right, so let's take some questions. And again, thanks. Hopefully that helps. Let's take some questions, and then mainly about trading, and then if not, I don't mind doing some charts. Let's see. Okay, so is the alphabets ABC in your charts downtrends? Those are corrective waves. So what that means is the main direction of the trade is the direction of the numbers. So that's the impulse. So 1, 3, 5. That can be a downtrend. So you could have an impulsive downtrend. And in fact, C waves are usually divided in 5 waves. So the trend within the C wave is down. But the ABC are the corrective against that move. So let's see, go back to my image. All right, so go back to this image. So the main trend is going this way, and the numbers indicate that, or we call it impulsive or motive. And then the corrective waves are the ABC, so they're against the trend. So when you know I have ABCs on the chart, that's not the main direction of the trade. That's the basics. But you can flip this whole thing over so that the 5 waves is moving down. That works. And so you'll see that on C waves that they are subdivided into 5, but you have to just recognize that they are pointing to a C, which means the larger trend of the next degree that we're really trading is pointing the other way. So hopefully that makes sense. How do you get the highs and lows prices on display on chart? Okay, that's just, it's simple. That is indicators. Just type in pivot, and you'll get high low. Just type in pivot in the first one that comes up. So once you tap that, you'll get that. Okay. Okay, same question. If you are trading some fundamentals, can you please? If you are taking some fundamental, can you please diagonals? No worries. If not in the forum, I'm not sure I understand. Are you asking if I can explain a diagonal, like the structure of a diagonal? If so, I actually have a post on that, so I can actually find that. Let me know. I'm not sure I understand the question. So if using TV, we never want to use built-in linear fib tool. Absolutely correct. You do not want to use. You do not want to use it. You want to use our scripts. And then I think it's Fidu. I think is the way he pronounces his username. I can post it. He did the latest update on the code and directions on how to do it, so we can find that for you. It's not XYZ. It's sort of a different version. It's WXY, and what it is let's find the latest and on the latest suspected one on Bitcoin. It's basically an ABC that it doesn't not that it really truncates, but that it doesn't put in a full 5 waves in the C. And we get it a lot in cryptos. I think I counted something again like 15, 16 in 2015 on Bitcoin alone. So again, I suspect this, it's not confirmed, but I suspect this to be a WXY. So if you look, we have 3 waves in the A wave, 3 waves in a B wave, and then we have 3 waves here. And this 4 is above what I call 4-wave resistance. Some of the analysts will allow a 4th wave that retraces 618 of 3. They always fail if they do in my perspective. I have never seen a 4th wave retrace 618 of a 3rd wave and really end up being a 5th wave. And even right now, I can't call this a 5th wave down at all. It's possible that this is a giant 5th wave based on this scale, but I think it's better to call the bearish either an ending diagonal, with this being wave 1, which will be huge and probably hit our bull market support. We may have a B wave triangle now, potentially. I'd like to see it invalidated, and then it's also possible that we have a leading diagonal pulling us out of here. It's still valid, with this being 3 waves in a wave 1. So there's too many possibilities on this chart, but I do think this is already confirmed as a WXI bottom, if not just for the A wave, and that's because we have basically a 3rd wave in the C. It's pretty clear to me. It's crystal clear to me, but I had some users argue with me about it. So hopefully that makes sense. WXI that you mentioned, that's okay. I explained that. It's just another version of a correction again. Okay, so the diagonal. So Mohammed, I'm gonna point to I'll do this on the site. I'll point to an explanation of the diagonal in a post that I did, and I also explained how to spot a diagonal in progress, at least a large one in the situation, because we had a lot of them. So I'll do that on the site, and you'll see it. It was a pretty good post, and I think it helped a lot of people. Let's see. How do you trade B waves with regard to entering setting stops? You don't trade a B wave. Or well, let me, I guess a better way of stating that is how to manage something if it's potentially a B wave. So let's see if I can explain this. I wish I had motive wave. Let me see if I can do this very quickly. You know what? I'm gonna draw in here. I think that'll be the best way to do it. That's a good question, actually. It's a really great question. And but you don't try to trade a B wave. You try to avoid them. So as soon as you know they are, basically you get out. Um, oh, wait, insert slide. Where is it? New slide. There we go. Um, all right. So we have a correction. And then the question is this an A wave or is this all of our correction? Do we get a B wave? So what happens is we get the first up. And if it's not clearly five waves, I mean, a lot of the ones we have are pretty clear five waves, but we want to be careful still in case they're fooling us. And we get three down. And then what happens is we get a box. We get a box that is basically, oh, come on. We get a box that is basically the 1.0 extension off this versus the 1.68, 1.1, or sorry, 1.618 is the third. But we get a box that's the 1.0 to the 1.382, which is often, that's basically log symmetry for A equals C for the B wave. So A, B, C. And so what you can do is move a stop up that is, if you look at my support for 3, 4, they generally hold half of the length of 3. So if you move a stop at the 50% mark as this progresses, so price is progressing. So let's say it's here. As this is moving, you would mark the 50% in log. Make sure you're using log calculation, and moving that up as price progresses. Eventually, if you end up with a top here, you'll see it in that 50% stop. You don't want to necessarily stop right at the bottom of 50%, but it's a warning. And if you start to get a retrace and push through, you likely have a B wave top. And it's even more, and I tend to wait for 5 down because, put a line. So we start to get, say this is a 5 wave move down. What I tend to do is if I see that out of a B wave top area, you'll get a retrace. There we go. So we'll get a retrace up, which is the 2 of a C. So if we get a 5 down in this area, it's a warning. We get a 3 wave up and then it fails, then we have the start of a C wave. So I don't tend to stress until I see 5 down, and then I watch for an exit. I mean, that's really advanced trading, but I tend not to run just when stops are hit. I tend to run on the retrace that fails. So hopefully that makes sense. With BTC dragging others down of late, would you be more advisable to take higher percentage off at top of 3? See, here's the thing. If something is clearly a third and is pushing past all the fibs, it just tends to hold support. So the other worry is that it's a B wave top. So again, if we get a 5 wave, just like I explained, 5 wave out of a B wave top, then absolutely. But I have seen many cryptos buck the BTC drag while they're in thirds. It's just the nature of what's happening. So BTS right now, I really doubt that thing comes down if Bitcoin tops. It might come down into a small retrace within the third wave, but I really doubt that it will drop. Now you can be safe for sure. I'm also not fully convinced that Bitcoin is going to come down. It may actually continue to buck the weak price that it's got right now. So that's just the way I trade. I've done this, for a couple years the same way. I can understand being nervous and you're new to it. You may want to take more profit. That's totally understandable. So that's really where it's just very personal. So I'm giving you my take, but you should take a personal a view of it. I'll explain the diagonals on the site. Could you please touch a bit upon how to utilize volume for identifying wave patterns? So I don't use volume in my trading except when I'm trying to scalp. So I've seen volume evolve in many different ways. I'm sure there's someone that's better at it than I am. So unfortunately, I'm not an expert in the way volume, but I do, often volume comes in at capitulations, often comes in at tops as folks start to chase, but the trap starts to begin where sellers come against it. So we see peaks. We also see peaks in volume, but sometimes weaker in third waves because you have that point of recognition where all the folks who feel like they're out and it's breaking out start to get in. But often I see volumes the biggest during during capitulation and then big shifts in the market. The problem I have with volume is that it's always evolving. So there's more volume coming into this market right now. So what is enough volume to turn the market? Um, it's changing all the time. And I know that there are people with better methodologies than I do for sure, and so they're probably better to follow in that regard. I know Day by Day does a lot of work on volume and knows a lot more than I do, mathematically. So you might even ask him. But he's not an Elliott Wave guy, so he might give you a slightly different answer. So I'm sorry I can't help that much. But again, I use it for scalping. Again, if you look at the way volume works, when something hits a fib and you see volume come in, it usually means it's going to turn. So I will look at volume and see if there's a big shifts around those key fibs. But mainly when I'm trading very short term, and then that pertains to a cumulative delta. So a friend of mine, we've been working on a tool. He's been doing the coding for watching order books flip, and it's actually revealing some things. We're just not done with it. Um, if we miss an ideal entry, then it would be best time to re-enter the trade at the next wave 2 or wave 4. Well, if you miss an entry and you still want it and it's progressing as third, you might consider just entering in the middle of the third, but you just have to size down. So you have to recognize how far you are now above stop, and you've got to take risk accordingly. That's the main thing I'm trying to say is how use skew. So you have the best skew when you are down in a wave 2 and 4 if you're trading the 5. And as you start to progress, as the trade starts to progress already, your skew goes away. So you need to size down, or you should. So it's okay. Again, I don't advise people do it all the time, chasing trades. But if you do really want something and you see my chart's got a nice run on it, just manage accordingly. And as long as you understand where the stop is, you might be okay. So again, that's a general advice, not a specific advice. So it's really case by case. I do it sometimes. Like if I see something in the heart of third, I'm like, I'm gonna throw a little bit in there and catch that fast ride. But I'm just not gonna do it very heavily. So hopefully that helps. Let's see. Whoa, big question. Let's see. To be clear on the meaning on the red bar and the stop, we look at entering across the red bar in a vertical manner with less at top and more towards the bottom. Yes, that's my advice, or at least in general. I don't always do it myself. But that's best practice. The stop is at the next lower fib, not at the bottom of the red bar. There is a tight stop at the bottom of the red bar, but I bet again you'll get spikes below it quite often, so you get a stop run. I, as a practice, will use that as a warning, and then if it retraces up and pushes back through it again, then I'm out. Generally, there is another looser stop at the 764, which is below my boxes on the wave 2. And you can ask me if I haven't put it on there. I've been trying to put them on the charts lately as just a line, not a box, because if I put a whole box, people will think it's that broad, and really the 764 is sort of the stretch. It's where I start to freak out too. So hopefully that makes sense. Let me know if that didn't answer it. Whoa, we got a lot of questions. Let me time stop this, and then I'll take more. I'll take more questions on the board if that's okay. So I'll give us about 10 minutes, and then I'll have to hang, and then I'll be on the board. Just to clarify, if we have the wave 3 ending at 100 and the estimated wave 4 is 0.618, does that mean the expected retrace is going to be down to 62? No, it's log, so I can't do that in my head. I put the calculations on one of the slides, and the slides will be available, and this will be recorded. So it's a log calculation, so it's not quite linear. If you had if you had a real, let's see, like if we're trading Forex and you had a really small change in price percentile wise, it would be close. But as you have basically the way log works is if you have a bigger percentile change in price, it changes over time, or it changes the calculation quite a bit from linear. So you'll have to look at those numbers. So understand the concept of custom fibs, but why? I don't know. I understand the question. Custom fibs? Do you mean log? If you mean log, actually, it just doesn't work. If you don't use log, our Fibonacci pin model doesn't work on cryptos because cryptos put in such big percentile. Again, like if you're using Forex, when I'm trading Forex, I usually am using the regular fib tool. But when I'm trading cryptos, I'm using a log tool because otherwise none of the targets are accurate over time. They're just not. The calculations are completely different, and that's because you look at Ether that went from 41 cents to $21 in in wave one, that's a big percentile move versus something that wave one is like, say, 3%. It changes all the calculations if you're, and the difference for third wave, if you use linear, the third wave target for Ether was $39. And here we're sitting at $1,100. And the target for third wave is $3,500. That's what that range does to all the log fib calculations. Completely different. And it took me a while to understand that. It was a guy named Roy on the main market who posted about that. And then I started doing my own calculations when Ether was pushing over 40, and I said, "Holy crap, this thing's going to 3,500." And that was the beginning of that was roughly March 2017 that I realized that. So that's the difference. That's basically what happens if you don't. Hopefully I answered that about B waves. When you refer to log scale, are you saying the same as semi-log, which is only option motive wave? Yes, that's right. Is there advantage of trading out from an alt to F versus, well, the advantage is that they're lower beta, lower volatility. So Ether and Bitcoin are still high volatility assets, but they're low volatility versus most alts. So if everything's going over the edge, not a bad idea to trade out into those and just manage the heat better. I usually go to fiat personally. When you get to the charts, could you review areas of profit taking and stops and PTS? Yeah, sure, no problem. Thanks, Ryan. Okay, let's see. I'll take these two more questions. Do we have some resources understanding logs? I would, again, get the code. I'll try to post it in the main room if I can find it again. Get the code in TradingView, and I'll post the formulas as well so you guys have it. It's just, build a spreadsheet based on the formulas. You know what? And actually, I have a spreadsheet, so I'll post a Dropbox link to it. So you have that. So you have all the log calculations in a spreadsheet. You can work with it. Hopefully that helps. Okay, guys, I think that's enough questions. I'll be on the board. I'm going to take a break. I'm going to walk the dog, and then I will be on the board, and then we can chat and do some charts. I think some things are starting to heat up, so it should be nice. All right, thanks, guys. Talk to you later.